53 years in your investing career, there have been 3 sea changes, and we are in one of them. What does that mean?
Well, I did a bit of macro research today. I wish I hadn't. I need to get out of the house a bit and process what I've been reading. The world stock markets are in a bit of a weird position at the moment. Last year was tough for investors as more speculative growth stocks shed incredible amounts. In general though, everyone lost around 25% of their portfolio as the crash moved money into the safer parts of the market. We've now recovered slightly and are going into really uncertain territory with equity prices. Some analysts are suggesting that the recent movements are a bull trap. That's where there's a temporary rise in the stock market followed by a lot more pain. And so far, there are plenty of indicators that there's a recession coming later in 2023. And I don't think it's news to anyone right now that the more ropey banks are beginning to suffer. Warren Buffett famously says, interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there's a very low gravitational pull on asset prices. But I guess the opposite happens when interest rates go up a bit. This shouldn't be new to anyone though, and has been discussed in various places for well over a year now. But this next bit might change things altogether and drive that final nail into this cycle's coffin. Since 2010, interest rates all over the globe have been near zero as we recovered from the 2008 financial crisis. When global consumer prices began to rise, core inflation rose also. So central banks all over the world needed to raise interest rates before things got out of control. This is a great indicator for a recession, no doubt at all. But stock market prices and also business earnings have not responded to this how we expected, with record profits still being processed. If high profits are still being posted, it means that consumers are still spending.
The consumer is, if you look at it today, in great shape. But I'm telling you, that's going to end at one point. But even if we go into recession, then the consumer is entering a recession in better shape, far better shape than they did in '08. You know, in '08, when we went into that recession, not only did unemployment go through the roof, but their home prices were dropping dramatically, jobs were disappearing, the stock market was way down, so this one is a little bit better than that.
Now, if consumers were to stop spending, prices would then stagnate or even fall. Businesses won't make as much money, they can't grow as fast, and most importantly, they probably won't need as many employees. Unemployment is still very low, even though the amount of jobs that are outstanding in the UK are slightly shrinking. But unemployment itself is almost at an all-time low on every chart around the world, and if businesses aren't shedding employees, it usually means that businesses aren't in recession-level trouble. Yet. This low unemployment rate has been giving hope to investors attempting to prop up the stock market, many even thinking the chances of a recession are virtually non-existent at this point.
You don't have a recession when you have 500,000 jobs and the lowest unemployment rate in more than 50 years.
You ever heard of that soft landing, hard landing? Now we've got no landing. I think to make this assumption right now is just dumb. Because historically, low unemployment isn't a sign that the economy is doing well. I know that's not what people normally think. In fact, surprisingly low unemployment, and I mean unemployment at all-time lows, is a really good indicator that the recession could be coming. It's often the last thing in the economic party to collapse. Since the 1960s, a large stock market crash has mostly been preceded, lastly, by a rise in unemployment. It's quite frightening how accurate this chart is. The only thing that's more accurate than this is the fall in house building that usually happens just before the growth in unemployment. And that's taken a significant turn for the worse in the past few months. So while many are calling for this as the return of the new bull market, the story is actually running exactly the same as previous recessions. The timeline is just heavily lagging, as it usually does, and moving so slowly that you probably don't even realize it. Okay, so now we're nice and fearful. what the fuck do we do about it?
The business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money.
Right.
Or, it's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years.
Right.
So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years.
I can only tell you what I'm doing, and I have to stress, again, I'm an idiot and it might not necessarily be what others should be doing. You've got to come up with a financial plan of your own. But the benefits to spotting this unemployment trend is we probably still have a bit of time before this disaster hits. It might not happen in the next few months. Historically, it can take 2 years before the unemployment rate ticks up enough to start worrying investors enough to start dropping the market. The S&P 500 has fallen brilliantly over the past few months, hitting us all pretty hard. Even my trading 2-on-2 portfolio, which has performed really well during the bear market, is sitting in the red. The PE ratio of the S&P 500 is sitting around 17 times forward earnings. That's getting really close to that average of 15 times earnings. It could be a really good time to buy. Historically, the drop to average isn't good enough, and it's not until we see the real panic setting in at below 13 times earnings that we start to see a recovery. You can stop buying equities and move into cash or government treasuries. Not a bad strategy. Not a bad strategy at all. It's a perfectly rational stance for anyone who is worried about their ability to sleep at night during these uncertain times. If you really can't take the pressure of the stock market dropping another 10-15%, and that's what I think it will do, the stock market probably isn't for you. Hell, it might not even be for me either. But remember, if you do go to cash, the recovery of the stock market is near impossible to predict. You won't know when employment starts to recover because it happens so slowly and so cautiously. And history tells us that missing out on those recoveries in the market is far worse than absorbing the bad times. And I need to mention here too that in the years after investor sentiment is low, like it was last year, there's usually an incredible recovery over the next 12 months. So you just need to bear that one in mind as well. This option, I feel, is for the traders, the rich people, and the gamblers. You know who you are, and good luck to you. You could also keep investing gradually into index funds. Forget about the market, don't look at your money ever again, and keep living as you are. And there's so many advantages to that as well. There's nothing wrong with it. Just remember that if you bury your head in the sand, you might have to take a dick in the ass every now and then.
Yeah, this is stupid.
Stanley, there's no time for your immaturity. Do it!
But I think my strategy is to continue buying businesses and investments that I think will survive a recession. This is my strategy. Take Tyson Foods, for example. It's taken a beating recently due to excess supply in pork, beef, and chicken products. I think it's temporary. Interest rates are going to reduce the rate of return for Tyson Foods. There's no doubt about that. I don't think it's got particular pricing power or a strong brand power that's going to give it a premium over other brands. But considering its position as the largest meat packing company in the US and it's got consistent revenue growth, I'm fairly convinced that its market position will help it continue to produce cash in the future. I feel this is the same with Blackstone, Digital Realty Trust, Brookfield Renewable, Alphabet, and Warner Brothers. I think these are all companies that are going to survive and they're going to thrive after the recession. And that's, in my opinion, all you can really do at this point.
Only invest in good companies. Try not to overpay, then do nothing.
My portfolio has taken a beating in this last week. At the end of February, I was again trailing the market after a temporary gain. One thing that is increasing though is my dividend income. As I introduce more money into this portfolio, I gain greater monthly payments. And I feel like this is a really good psychological boost to my investment journey. That is, of course, until the cash in these companies starts to run out. So I'm taking a bit of a hit at the moment, but one thing I am excited for is what Howard Marks was referring to earlier in his interview, that the sea change seems to be happening. This change back to normal interest rates could make big changes in the market and the way investors work. It's going to create inefficiencies in the market. Market metrics might actually start to make more sense where they didn't in 2021. I'm looking forward to that. My dividend payments in the month of February were looking pretty good. I got $15.27 from JP Morgan, £24.80 from AT&T, $14.43 from Blackstone, $8.59 from Realty Income, and £9.57 from the lovely ASML. The spread of the sell-off meant that I began to underperform my benchmark again, with my portfolio now only being 11.37% in total return. But looking at my personal savings coming into April, it looks like I should, I'm gonna say should, be able to achieve my goal of filling my ISA for the 3rd year running. It's gonna take a bit of fancy accounting, but it's doable. I don't know what I just admitted to there. I mean, it's been a tough year with a couple of expenses that were unplanned, but we should be able to make it. I'm just leaving the money in the cash until last minute, and then I'll figure out a place to invest it because I'm not entirely sure where I want to put the money right now. Thank you so much for watching though, and I'll see you on the next one where hopefully I'll be filling my ISA. I hope I didn't scare anyone too much. It's not supposed to do that. It's supposed to just be level-headed looking. And, you know, me talking it through here on camera right now just makes me, the whole point of it is to make me feel like I can get through this and I can keep adding to the market. Should I go gym?